Okay, good evening everybody. Welcome to Barnsley Civic Hall for the annual general meeting. Just one or two housekeeping items before I introduce the panel. There's no fire alarm planned this evening, so if the fire alarm goes off, it's for real. Fire exits at the rear of either side. Wheelchair egress on the side over there. The toilets, ladies at the rear on my left and gents rear on my right. And can I just say the first three rows on this side are serviced by a hearing loop. So that might be useful. It would certainly be useful for me. If I could just briefly introduce the panel, working along from the left. We've got Councillor Martin Lawson, who's the chairman of the South Yorkshire Pensions Authority. Councillor Richard Wraith, who's the vice chairman. Gary Chapman, who will be doing the second of our presentations on the admin report. And Gary's the head of pensions administration. And finally, John Hattersley, who will be doing the first presentation on accounts and investment report, and John is the fund director. Part of the feedback that we've had in previous years is that we should allow as much time as possible for you to ask questions, so the presentations I think will be slightly briefer than they have been previously. And just to say, there is a buffet organised around about 7:15. The chairman will make some closing remarks at the end of the session, rather than introductory remarks, which has fallen to me. So without further ado, I think we'll hand over now for the first presentation of the evening.
Good evening, ladies and gentlemen. Welcome to the annual meeting. Just to introduce a new face to you, Steve Pick, who gave the introduction. He's our new clerk and treasurer. He hasn't been with us very long. He replaced Bill Wilkinson, who retired, as you know, during the year. So Steve's a new boy, so he's got all the answers to all the questions you're going to ask tonight. I hope. Those of you who are regular attenders to this auspicious event will have heard me comment before about the auditor and the state of the accounts. I mentioned last year that changes to the fund accounts arising out of new accounting standards had contributed to the annual report getting even fatter. I questioned whether this move to supposed transparency would be successful, and so suggested by adding 24 pages of notes last year that it wasn't going to be. Well, I was wrong. This year, we've got 37 pages of notes to the annual report and accounts. I suppose that's progress. You have a copy of this slide in your handouts, so if you can't read it on the screen, maybe it might be easier to read it in the handout. This is the fund account for the year ended March 2012. It is, of course, a snapshot as at the end of March, but it gives you a flavour of what the fund did over the period. The first point I'd like to make is that contributions received, 221 million, fell roughly 12 million compared to the previous year. Both contributions from employers and members fell. That reflects the change in membership of the fund. As you know, of course, employers' contributions are fixed for 3 years, and employee contributions are fixed also by law. If you note from the slide, though, there's an important fact here, that only about a quarter of all contributions actually come from employees. Over time, the ratio has been closer to a third. Going down the list, not surprisingly, the amount of money paid out in benefits rose. This year, the fund paid out 232 million in pensions, lump sums and death benefits. Last year, the sum was 211. The year before, it was 184 million. So you see there is a gradual progression in benefits being paid. Also, of course, this largely reflects the decisions of the main employers, the district councils and other employers, to reduce their workforces over the period. As you know, that's in response to cuts imposed by central government. You'll also note that for this year, for the first time, total contributions themselves were less than the monies paid out. It's not the size of a deficit that is significant, at only £12 million, but the fact is that there is a deficit at all. Like most pension funds in the UK, we are maturing, and this is only to be expected to continue. Now, before you start panicking, I can say that money is not running out. Indeed, far from it. Recent work by the fund's actuaries confirmed that based upon current assumptions, current contribution patterns and return evaluation assumptions, the fund is cash flow positive for around 15 years and has enough assets for another 60 or so years. So nobody's going to run short of money. And of course, increased level investments or increased contributions will extend the life further. It always has to be remembered that this fund, like all other funds, is maturing, but the things do not stand still. As new members enter and the rules change, the life of the fund is set to go on for a number of years. We know we have enough assets to pay for a number of years. One of the major differences between the LGPS and the other public sector schemes is in fact the fact that we have assets. We are a funded scheme. And it's very important to remember when you read press reports about the teachers or NHS or other civil service schemes that they are not funded. They are paid directly out of revenue. Your fund has material assets to support the pension promise. Those underlying assets are producing independently generated income. Whereas, as I say, the other funds just get paid out of general taxation on an as and when basis. And this year, you can see from the slide, we saw a healthy increase in investment income. It rose to 127 million compared to 110 million last year. Net property income, i.e. rents after expenses, rose by 4.5 million to nearly 17 million. But the biggest increase came from share dividends received, which rose by over 12 million to some 75 million pounds in total. The other biggest source of income came from bonds at about 30 million pounds. As I've just mentioned, investment income is growing in importance because as an asset, it needs to meet our cash flowing requirements. And we are already exploring with funds advisors, the actuary, how that income stream can be enhanced without increasing the underlying risk. As you know, the authority has always been cost conscious and has had tight budgetary control. Like you see from the slide, this year administration costs fell, actually slightly year on year. Although the VAT liability rose, both internal and external expenses were contained well within budget. At the end of the year, the net assets of the fund had increased by some 220 million, and the fund ended valued at just under 4.7 billion pounds. It means the fund continues to be one of the top 50 pension funds in the UK. During the year, investors faced some of the most challenging conditions in living memory, as the global economic slowdown and debt crisis in Europe caused markets to be dominated by politics and by central bank intervention. In newspaper speak, it was a period of risk on, risk off, and this led to short-termism. In fact, all you ever saw in newspapers was short-termism. Long-term investors, like pension funds, find this a very difficult environment in which to make money. Shorter-term investors, such as hedge funds or day traders, should find those conditions much more amenable because they can trade in and out of the press of a computer button. We, as a long-term investor based upon fundamental values, don't operate like that. It's against our instincts and against our long-term aims and objectives. It does, however, mean the markets are increasingly dominated by short-term traders rather than traditional investors. That sort of trend has in itself all sorts of implications for corporate governance issues, but that is another story for another day. Now, last year, the average local authority pension fund returned just over 2.6% because of the conditions. Your fund did better than that. We achieved 5.5, even though that was a slight underperformance against our benchmark. This slide shows how the fund was allocated at the end of March. Those of you who've been to these events before will remember that the fund structure is primarily based upon something we call the customised benchmark, which is in itself meant to reflect the underlying liability structure of the fund. As the fund matures, that benchmark will also change. Now, as you know, the art of investment is all about reconciling the lure of return against the acceptability of loss, or in other words, risk management. And as the fund matures, the requirement for the regular and sustainable income increases. However, because there is a notional deficit in the fund between the value of the assets it owns and the size of its eventual liabilities, and that gap can only be reduced by investing in assets which produce above average returns, we have to have a mix between growth assets and liability-led assets. To take on and achieve those returns, the fund has to take an element of risk. There is no reward without taking risk. By diversification across assets shown in the chart is one of the ways that we can try and control risk. Risk cannot and should not be eliminated, but it is prudent to ensure that within each of the asset classes further diversification takes place, and that is how the portfolios are managed. So, for instance, the returns achieved reflect to some degree the risks taken. Last year, for instance, the overall return from the bond portfolios, there the fixed interest on the 22.7%, was indeed about 22%, whilst the returns produced by UK and overseas equities were only 2.2%, and indeed for overseas equities was a negative 2.5%. However, those numbers themselves mask very many variations. For example, the holdings in American and Japanese shares actually produced positive returns at 7.8 and 3.6% respectively in sterling terms, whilst the continental European portfolio, obviously dominated by the effects of the Eurozone, had a negative 10.4% performance. You'll see the fund has a large exposure to property, nearly 10%, and last year that had a very good return, returning nearly 13%, 12.8 to be precise. We had an outstanding performance from the agricultural portfolio last year. Now, as part of the balance between risk and return, we have a very heavy, and the need to match our income going forward, we have a very heavy weighting in bonds, and that helped the fund during the first 9 months of the year, but actually it hindered during the last 3 months of the year. As I said, there were very volatile markets last year, very topsy-turvy, and sentiment completely swung round from the beginning of the year to the end of the year. The last quarter, when equities outperformed, were helped by a degree of optimism as markets began to think that the beginning of signs of solutions to the European crisis. The European Central Bank, for instance, made one or two initiatives into market movements, and the politicians then seemed to be getting their act together. However, as you know, that sentiment didn't last long, and markets, until very recently, broadly moved sideways. Every year, the authority receives a presentation from an independent performance assessor, the WM company, and they highlight the fund's performance against its own internal targets and against other local authority funds. Now, even allowing for the bad returns we achieved in 2010, the fund is ahead of its benchmark over 10 years and ranks 9th in the local authority universe, having achieved 11th position last year. More importantly, though, the WM analysis reiterated their previous comments that the fund continues to produce above average returns for below average risk. And this rather busy slide demonstrates that. The solid box is your fund, showing where we are in terms of absolute risk and in terms of absolute return compared to all the other funds. So you can see we are achieving solid returns but below absolute risk, average risk. Now that's all I really want to talk about regarding last year's performance. So I want to try and look forward to this year and the issues the fund will be considering in 2013 and the actuarial valuation. Gary will touch upon these and the implications of the 2014 scheme later on. But I do want to draw your attention to the changes that are taking place in bond yields. That may be a very dry subject, but it's actually very important to pension funds. Now, as I've just said, our bond portfolios produced a good return last year, and that benefited the fund. However, there is a negative side to that good performance, and that is a way to increase the cost of the fund's liabilities. This slide, prepared by the fund's actuary Mercers, shows just how low real yields on UK government bonds have become. You can see that over the period covered, they've gone from 14–15% down to just 3–4%. Now that is a dramatic change. This is important because the actuaries actually measure the cost of the liabilities on bond yields. So the lower the bond yield, the higher the cost of those liabilities, and therefore the bigger the notional deficit. This is a major concern for pension funds. Not only is it reducing our income, but it's increasing the cost of liabilities. Now it hasn't helped because of the Bank of England's policy of quantitative easing, as you probably read in the press. The bank has been buying government securities in an attempt to put money into the economy by shoring up the bank's balance sheets. But that has had consequences, because as the Bank of England continues to buy gilts, it's forcing down yields. And in a period of historically low interest rates, that has just compounded the problem. Now, the bank has been criticised for this, and recently just produced a paper purporting to deny that view, that QE has actually damaged pension funds. But even that report had to concede that those schemes which were already in deficit in 2008, before the financial crisis, have seen their deficits increased. So this is a common problem to all public sector and private sector pension funds in the UK, and indeed in the Western world. Low bond yields at historically low levels are not pension fund friendly. By keeping interest rates low and acting as a buyer of last resort of government bonds, the Bank of England is now thought to own about 40% of the government bond market. The authorities are actively distorting the market. Now, there might well be legitimate reasons for doing this, but we are beginning to question the effectiveness of the strategy in boosting the real economy. Now, the problem facing UK pension funds is not just limited to managing and living with current yields, but equally importantly, trying to anticipate what the consequences will be when those yields move, and they will have to move at some time. As the yields then increase, liabilities will be reduced, which is good news, but so will the value of any bond assets we hold. It is a great unknown and one of the biggest challenges pension funds face. Now, the biggest challenge that the actuary will be facing when it comes to doing the actuarial valuation next year will not be the result of relatively poor investment returns, but it will be the burgeoning cost of liabilities as valued by the move in bond yields. And this is a point we're already making to employers ahead of the actuarial valuation. Now, this move in bond yields has not just been restricted to the UK. Indeed, at one stage there were 4 European countries where lenders were actually receiving negative returns. In other words, they were paying governments to take their money off their hands. They were willing to be charged a fee by lending to the Swiss government. Currently, there are 2 governments, Denmark and Switzerland, where 2-year bonds are attracting real negative returns because the investors want to find a safe home for their money. Now, to illustrate this effect on low bond yields, let us have a look at a typical average American. I'm using American because the data is clearer. A 35-year-old American earning an average household income of $50,000 US, if he wants to retire with 70% of that figure as his pension, and if you assume a 2% inflation rise over his lifetime, and he has $75,000 worth of savings, he gets a state pension of $1,800 per month at age 67. At the moment, using average long-term bond yields as a measure, he needs to save $6,900 per year to get that nest egg of $485,000 he needs by age 67. In other words, he has a current savings rate of 14% of his income. As I say, it's a dry subject, and in previous years I've tried to get it slightly more interesting by asking one or two questions. And your first question tonight is, given present bond yields, what is the current savings rate he needs to achieve the same outcome? So at the moment, he's paying 14% of his disposable income to get the pension he wants, based upon average yields. Based upon current yields, is he 16, 23, 32, 37, 41, or 50% of his average income he needs to save to prepare for his pension? This is to demonstrate the long-term nature of pension funds and their liabilities. I've already shown how dramatic the decline in yields has been over the last 30 years. We are a very long-term fund, so it's interesting to see whether politicians understand that. So the second question, how many pension ministers have there been since the post was created in 1998? 3, 5, 7, 9, or 11? What was the shortest period in office? 3, 5, 11 months? 1 year, 4 months? What was the longest period in office? As you see, ministers and politicians don't necessarily understand just how long-term pension funds are and the problems they face. Thank you.
Evening all, nice to see you all. I thought seeing as we're in Barnsley today, I'll do my presentation entirely in a Barnsley accent, if that's okay. Shall we? Just allow me to sort the technicalities out here before I start. Wow. Okay. I think for most of you I've seen before, and nice to see you again. I think you're probably used to what I'm going to say right now anyway, but in terms of the start of this, what we would normally look at is the membership statistics and to see how they've actually changed during the year. What we're seeing here is a definite trend where you can see active members are starting to reduce and the deferred and pensioner members are starting to increase. This is of course the link to what John was talking about in terms of cash flow. Kind of nicked my joke because I was going to say like I'll be 110 when money runs out, so you know basically we're all okay. But the work that district councils have been doing in terms of trying to reduce staff due to the problems that they've faced is clearly having an impact on the contributors into the scheme. We're starting to see less members. I had a question recently that came to me which was basically, well, how come the active members haven't gone down as much as the pensioner and deferred members have gone up? Well, the answer to that is that, yes, there is still recruitment. It's not a closed scheme. We're not seeing no new members, and certainly, yes, there have been redundancies at the councils and significant numbers indeed, but there will still be normal type retirements. There'll be people just leaving and moving on to other jobs and things like that. And of course, certain key jobs hopefully are then being replaced. So we're not actually seeing the same numbers, but nevertheless, the trend seems to be continuing. And I looked before I did the presentation and we're currently about 49,276 in terms of active members. So you can see that in the interim from this figure being done at the end of March, we've actually then lost even more members. But as John said, the cash flow is still there. It's a mature scheme. It's the sign of all pension schemes. Eventually, they will all tip up that way where the pensioner members and deferred members will eventually outstrip the active members in the scheme. Just really to show you how we can exploit the massive amount of data that we've got on board these days, and the power we've got to look at it. And these are just some statistics that I thought might be interesting to you. We've got a wealth of information, and as part of the developing annual report, we will try and put more interesting fund statistics in every year, just to engage with you, to show you what we know about the fund and what trends we can try and draw from that. The fund is currently split 68% female to 32% male. If this was 30 years ago, that probably wouldn't be the case. And this is across the whole fund of 128,000 members, so that includes the active members, pensioners and deferreds. But pensioners are about 60-40 female to male, which again, when the scheme started, it was probably predominantly male, and then as time's gone on, it's gone the other way. But I don't know whether that's surprising to you, but it certainly is fairly surprising to me that there's such a big gap between them. Gold-plated pension scheme, it's not. It's a great pension scheme, and hopefully you'll all testify to the fact that if you're receiving a pension already, that's the case, and it's got certainly loads of benefits within it to ensure people get value for money out of the contributions that they pay. But the average pension for us in our scheme is 358 quid a month. And if you're on pension, you'll know which side of the line you are on that. But that's the average out of the 40-some thousand pensions that we pay. Interestingly, we don't move around much. 90% of the pensioners and deferred members still live in South Yorkshire, so that's a large amount. There are a few that have scabbed off to other counties just around, and you can see that you know, the Derbyshires and East Ridings and so on pick up quite a few. And then we've got 851 souls who've moved away and gone abroad altogether. And we have to try and keep in contact with them, of course, as we do. Looking at the sample of life expectancy, and I don't want to get too morbid with you, but we find that pensioners who are abroad, on average, live a year longer than the ones who are in the UK. So if you want to plan to move, you can do. Nationally, of course, and I'll touch on the new scheme in a little while, but the trend is for to try and get people to work longer by moving the state pension age, and certainly to hear people speak, yeah, everybody wants to work longer and so on. But in our scheme, despite the fact that 68% of our pensioners are over 65, 58 is still the average retirement age, so well below the state pension age and even below the eligible pension age of age 60 within the scheme. So, you know, it seems that it'll take a while to catch up in our area. Good news, I guess, is we've got 11 centurions in the scheme. It's still going strong, with the oldest pensioner being 106 as we speak. And if you ever get to 100, I guess with nobody 100 in here, but if you ever get to 100, we'll celebrate with you and send you a card and hopefully come and meet you. But it's just a sign of the times. I mean, the actuary says that people are living longer, and I guess if we'd have run this 10, 15 years ago, we might have only had 1 or 2 people living beyond 100 and in receipt of their pension. So I guess that is good news. Just for a bit of fun, I tried just thinking, well, what's the most frequent forename and surname? Well, according to this, there's about 50 out of 128,000. There's about 1,600 Susans, about 1,500 Davids, and then it goes down the line. My name doesn't appear on the top 20, and neither does my surname, which the surname which maybe you'd have guessed is Smith. For the forenames, I thought, well, okay, that's everybody. So what I'll do is I'll have a look at looking at what 18 to 30s are to see if there's any sort of modern names, you know, cropping up as like Moon Unit or Sunbeam or something daft like that. Well, it's actually female, it's Rebecca, and male, it's Matthew, and they're just as old names as Susan and David, I guess, but just a different era and a different way of doing things. But really, that's just to illustrate really that we've got this massive data about everybody and the pensions they're receiving and the reasons they got the pensions and things like that. And hopefully I'll be able to start to feed in things into annual reports and things like this to you that are of interest to you in years to come. Annual review it is. So about us, how have we done? Pretty good, I guess, as far as I'm concerned. During the year, in terms of cases processed, we did 28,268. Slightly less than last year when I looked at the slide, but importantly, the actual performance rating went up. So we did this year in 99.5% on target. That's against our customer service charter targets, which we're very proud of achieving. So it's an excellent performance. There's not much way for us to go, but that's where we're pushing it, and we are aiming to try and ensure we can keep this going and get as high as possible, because behind all this is my drive for customer service excellence, to ensure that whatever we do for you, we do it right and we do it on time and we do it to your satisfaction. So yeah, there's numbers there, but behind that is a case where somebody's asked us to do something and we've done it, and hopefully we've done it on time. The next one then says, well, we haven't done it right then because we've had 10 complaints, 10 formal complaints, which in my book is 10 too many. But 10 out of 28,268 ain't bad, but nevertheless, that is 10 complaints that we've had to deal with and trying to, we haven't satisfied a customer during whatever it is that they asked us to do. During the year, we ran sessions with all our staff involved in dealing with scheme members to help them deal with complaints, to give them tips and try to explain to them what they could do for members. Now, it doesn't mean to say that somebody coming along wants something that they can't have and you've got to give it to them. Obviously it doesn't, but you've got to manage how you deal with people and the scheme members, because they're looking for a service from us, and that's what we're here to provide. The internal disputes, they are ones which are more about the scheme rules and so on, and I'm first stage referee for those. And those are where somebody just disagrees with the method of calculation or something like that. Unfortunately, again, there aren't an awful lot of those. In terms of customer service excellence, we reported last year that we'd managed to secure the award, which was great, but there were just, we were only partially compliant in 1 out of the 57 or 58 criteria that we were assessed upon. Now that was great, I mean that is almost perfect, but obviously it wasn't exactly there. And we have an annual review, and the good news was that we managed to put the thing right that we were only partial with, so now we're 100% compliant. So we have the award for another year after this, and then we have to go through the whole process again, but at least we can now say that we're 100% compliant. Benchmarking is where we pit ourselves against the other local authority pension funds who participate in the survey. Not all of them do. I think the others are a bit scared to put their head above the parapet, but there's about 58, 59 funds take part, and this year we've done what we do most years, which is to come out as very high performing, but for a below average cost. Effectively, it works it down to how much money we spend on each and every one of you in providing the service that we do. And by these mathematical calculations, we end up being below average. But in terms of cost, but in terms of what we deliver to you for that cost, then we deliver more than most of the average funds do. We've been banging on for years about the performance and what we do. We've just said there 29,000 cases, which is a lot. So in trying to do something a little bit different here, I thought I'd just tell you a little bit about us, because it may not be all that clear. First of all, there's a nice picture of Town Hall there, which is looking really well. The thing that's not looking really well is our building where we reside in Regent Street, a nice 70s building. But that's where that's HQ, that's us. There's 81 of us based in HQ. 20 deal with the fund management side of things, that's John's team, and they look after investments and accountancy and things like that. And I'll let John tell you about them on another day. But in terms of what I'm responsible for, which is pensions administration, there's 61 of us in HQ. And we're engaged in different things, and member services, which is basically the people who deal with the scheme members, who do the calculations, who manage the database, who basically write letters out to answering queries and things like that. Basically the engine room where everything gets done, all the 20,000 cases that we've talked about. Then there's important to you pensioners, there's payroll, who pay you, and manage the ongoing payments as well as the new payments, bringing new people on board and so on. We have a technical team because I'm sure you know that this scheme is damn complicated and there's all sorts of little things that come up to bite you about the scheme. It's not always straightforward and so on, and we need a technical team to keep abreast of that and also of all the changes that we get forced upon us that then help the rest of the staff do their job. I've always said, I mean, I've been in pensions administration ever since leaving school, so I've been doing it all my career, but it's not an ordinary office job. There's an awful lot of technical stuff that you need to know, even from our new starters coming in to be able to do the job, and we need technical support on that to help people make sure they do the things right and we pay people correctly, so it's very important. Communications has grown over the years. When I first started, I don't think we ever sent booklets out, or we'd just be there on the end of the telephone and send a letter, and that was it. And now, today, we've got all sorts of things, as you know, and I'll not go through them because I've done that before, but we've got all the electronic media and things that we do, and booklets and the wide range of things, and events like today where we're communicating. And it's very important, and a communication team is essential for a modern pensions administration team. We're lucky in South Yorkshire Pensions Authority because we have our own IT section. Most pension funds up and down the country have to rely on their major councils' employers' IT and have to share them. We're lucky we get them to ourselves, and it shows because we're able to produce first-class systems that help our team and produce the information that we're able to produce for you. And all the stats that I did at the push of a button, and it didn't take me putting a request in and having 3 people scratching their heads and doing whatever they need to do to produce it. It's all there, and hopefully that does benefit all of us and all of you over time. We also have 12 staff based at the district offices, which are available locally to wherever you might live. The 4 buildings there, I don't know whether you recognise them yourself. I think the top left one is Arden House in Sheffield, and somebody correct me if I'm wrong. The one on the right-hand side is Riverside House at Rotherham, which is a new building, a nice building at Rotherham. The bottom left is Gateway Plaza up here in Barnsley, up by the Premier Inn. And the one on right is an artist's impression of Doncaster's new civic building, which is due to open on the 19th of November, or our staff are due to move into it on the 19th of November. All very much nicer buildings than ours, but there you go. And yes, we keep busy. Aside from all the casework, just to put things into context, we now have 220 active employers in the fund. That's employers. So that is employers who need to know about the pension scheme, who we have to talk to, and we have to make sure we get contributions from and tell them what their responsibilities are and keep them abreast of information and so on. And 52 of them are new academies. I don't know whether you've picked up on this at all, but across the country, schools are opting out of local education authority control and becoming academies on their own. And for the pension scheme point of view, that means that the scheme members that previously were employed by the council are now employed by a different employer, an individual employer who we have to service and deal with. So it's expanding, and I think if we look at this next year, we'll probably be about 240, 250 and counting. So it does have an impact on us because we've got more people to deal with. We actually saw 2,410 people individually. That is an individual appointment with each of these people to talk about whatever they wanted to talk about in terms of pension. We see everybody that retires, so that's a given. We have a meeting with them to help them fill out the form and so on. But all sorts of a range of other things that we do as well. We go out and do presentations for the employers where we go and talk about new starter inductions. We probably haven't done as many of those because of the lack of recruitment, but we certainly have done some. We talk about midlife planning, where we engage with people to see, well, are you ready for retirement that's coming up in the future, to try and help them understand what their benefits are likely to be and whether or not there's going to be a shortfall and whether they need to actually pay more or whatever. And then pre-retirement, which is in the years just prior to retirement, which we are part of a bigger session, but we explain what the benefits are and what they're likely to be. But it also prepares people for that day when you're actually no longer going to work again. Just this week we've done an employers forum where we've had 80 odd delegates from employers come and we talked to them about the scheme changes and things facing the scheme going forward. And it's an important part of what we do, because we've got to get the employers doing their things right in order so that we can make sure we're doing things right for you. And our staff have also been engaged in going around talking to employees about the new scheme. We don't know much about it yet, but we felt it was important that we actually went out to talk to scheme members to tell them what we did know, just so that they can be aware and informed of what's going off in the preparations for the new scheme. There isn't really anything bad about the new scheme at the moment. There will be winners and losers in it, but getting that message across is important, because certainly if you just leave it to the popular press or whatever, you're not going to get that sort of balanced view across. So we've done that, and we've talked to hundreds of scheme members. The bit you've all been waiting for if you've retired, I bet you've sneaked a look at this beforehand when you packed, but so far this is an estimate. It's based on August, so September's will be different, and it's September that it's based upon. But as we stand at the moment, pensions in payment and deferred pensions will be increased by around 2.5%. Which ain't as much as you got last year, but still more than we got. Nice picture, certainly ain't Barnsley, but it's not actually, it's more ironic than anything else as well, because on the horizon it's not going to be calm. There's plenty for us to be doing and thinking about. We've got coming along is the valuation of the pension fund, which we do every 3 years, which, due to the things John's been talking about here, is certainly going to be a challenge in a time when employers really can't afford to be paying much more into the pension scheme, but the liabilities are such that really we should be demanding more coming into the pension scheme. So we've got a difficult time trying to square that circle, and that's something that, you know, we started the planning with now. We've started to talk to employers early, and we'll continue with that. And this time next year we'll be in the throes of it, and I'll be able to tell you how we're going, but it certainly is going to be a tough thing. Auto-enrolment, you may have heard, there's certainly been adverts on the TV and radio and such like, kicked in from 1st of October for the biggest employers. doesn't kick in South Yorkshire for our biggest employers until next March. But what it means is that employers will start to have to bring people into the scheme if they meet certain criteria who perhaps otherwise weren't. It may surprise you to know that not everybody's in the pension scheme. People choose not to be for whatever reason. This is a way countrywide, not just local authorities, but countrywide, to try and get people to save for retirement. It is important, and certainly you do need a lot of money to get the kind of pensions that were on John's slide, but it's a challenge for employers. It's not so much a pension scheme requirement, but we have to keep an eye on how the employers do with this and trying to make sure that things are done right so that members who are auto-enrolled are done so at the right time and so on. So that is a challenge for us. And then there's the new scheme. To all intents and purposes, after having had the headlines about what the new scheme would be earlier this year, we were anticipating at this point in time having some draft regulations there to be able to see the meat of what the pension scheme would look like in 2014. Fortunately, and not surprisingly to me, that has been delayed, and that's not likely to come forth now until, well, I always joke Christmas Eve, but it probably will be Christmas Eve just as I'm going on holiday. But the point will be that there was an intention to try and get details about the new scheme all in place a year early so that we could start the communication of it, because it's going to be different, and there's going to be different things for different people. There's going to be options for people to pay less perhaps if they can't afford the cost of the current scheme, and things that we need to try and get across to both employers and employees. And at the moment we haven't got that detail, so it's coming, and certainly next year I'll be able to give you a bit more about it, but as it stands at the moment we just know the headlines, and we'll feed that in as we get the information coming along. So that's it for me. There's another slide coming up which you haven't got, but I just thought I'd put this up just for a bit of reflection before I then go and sit down. You all remember Dave, and sadly he died at the end of last year, which was a sad time for all of us. Thank you very much.
Hello. Can you hear me? Yeah. Sorry. Dave was actually at this meeting last year, so it's a doubly sad he's not here. Can we have some more lights on so I can have some idea of who's asking the question? Because I mean, there's a possibility that we'd turn our lights off and only put yours on, and then you couldn't see who was answering the question for you. But that's probably too complicated. Have we got any questions from anybody? I can see one from the third row up on the end. First of all, are you? Yes. Oh, you haven't got a roving mic. We have now.
A few years ago, you lost some money to the Icelandic banks. Did you manage to recover any of that?
At the moment, of the 18.5 million which was at risk, we've recovered all but 2.75 million. And all the expectations are that they will be fully recovered. It may take another 3 or 4 years, but as I say, we've recovered more than 13 and 14 million of that money.
Did you all hear that answer? Yes. The lady at the front next, I think.
I would like to ask, please, about the ABCs and Equitable Life. Have you heard anything about these, please?
Thank you. I was supposed to actually add that into my presentation, and not in the slides, but certainly add it into the thing, so thank you for reminding me. Yes, indeed, we've heard from the company that has been engaged to deal with the compensation scheme, and they've sent us a communication that basically starts the process for us to be able to then start to give them details of the members. Now, this is significant to us because up until that letter came, we were never actually sure whether our scheme members, who were pension scheme members with profits accounts, were actually going to be part of the compensation scheme. It hadn't been clear from the national information that we'd seen, but this was encouraging because now we've started to engage with them. So if you're in that situation, then watch this space and you should be hearing something from us soon.
Thank you.
Any more questions?
When we get our annual percentage increase, why can't the authority pay the full increase instead of the Department of Work and Pensions paying some, paying part of it?
Simply because the scheme rules don't allow us to do. The scheme regulations have within it the facility that the guaranteed minimum pension element of your pension, if you were in the contracted out served part of the state related pension scheme, the increase has to be paid with your pension. So in terms of the scheme rules nationally, not just in South Yorkshire, we have no option but to do just that.
Any more questions? No? Can I thank you all then for coming? There is one thing that we haven't done yet, and that's John asked some questions earlier, and I wasn't sure how you were going to get them to give the answers, or are you just going to put them up?
Well, I was hoping I'd be overwhelmed with enthusiasm. Right, the answer to the US savings question, as Gary says, it's not typical of the UK position, but the numbers are as real for the Americans as they are for the UK. I did have these to hand. The answer to the US is the guy is now saving $6,900 a year to meet his aspirations. Using current bond yields, he has to save $20,300. That is a 41% savings rate. Or in other words, his disposable income falls by more than 30%. This is part of the bigger pensions problem we're all facing in the Western world. So just to sort of say, the LGPS is not in isolation, these are worldwide trends, but just to show you the extent of what the financial crisis means.
Did any of you get that right? I got it wrong, I said 37%, so even your chair got it wrong. So anybody out there who wants to be an investment advisor who got it right? No? John, next one?
How many pension ministers have there been since the post was created in 1998? As I was making the point somewhat, that's what I say, just making the point, pensions are a long-term game. If you join the pension scheme, you're likely to be there for 40 odd years, one form or another. If you take in dependents' pensions and then maybe children's pensions, maybe 100. I think in a previous presentation, I pointed out how long it took a American Civil War pension to be paid. Well, the answer is, since 1998, we've had 11 pension ministers. Actually, only 10 individuals, because Stephen Timms had 2 goes, but we've had 11 pension ministers.
Okay. Anybody get that right? I was wanting to put about 15 down, but it's not on the sheet.
The shortest tenure pensions minister was only 5 months. That's really not long enough to go in all his letters. That was John Denham in 1998. And the longest serving pensions minister is actually his current one, Stephen Webb, who, if you've noticed, he actually survived the recent reshuffle. He's been there for 2 years, 4 months, and has stated that he wants to continue in the job to get things sorted out. So maybe at long last, there is some political recognition of the challenges we face and long-term nature of pension funds.
Can we thank John and Gary for their presentations? the average age for someone of 22 to die is 100. So actually that's 78 years, isn't it? So 60 is not long enough then, so I've done the work for them. But can we thank all the staff as well for all their work that they do during the year, because we have John and Gary here at the front, but it's all the others who actually do a lot of hard work behind the scenes who you never see. Maybe one year there ought to be a montage of all the people who actually work for you, so you can actually see what they look for. Otherwise, some of us say, well, if the people at the front never do the work, it's the ones you never see do all the work, but I'm sure that's not the case in this instance. The reason I'm speaking at the end and not at the beginning isn't because, like a politician, I saw that there was a score chart, and I saw there would be a score chart for me at the beginning, but not at the end. And being a good politician, I didn't want you to do it. That's not actually very easy, but we wanted to make it all short. But hopefully the food is available for you now, so if we close it at this point. And thank you very much all for coming, and I hope you found it of interest, and I do know that they would like a survey